If a multinational corporation just, changes the date on its calendar by 30 days, it can defer millions of dollars in U.S. taxes.
Well, or at least it could.
Right, it could. Until the Internal Revenue authorities basically woke up and decided to slam that massive loophole shut.
Yeah, exactly.
So today, we are looking at what happens when a global company decides to change its identity or its corporate structure or even just its fiscal year end.
Because it's a moving target, right?
Exactly. Because usually when you think about compliance or, filing a tax report, you imagine taking a snapshot. Like you look at a building, you measure the walls, document the dimensions, and file the paperwork.
Which feels static.
Right. It feels very static.
Yeah.
But when you are dealing with international tax reporting, if you try to take a static snapshot, you're already doing it wrong.
You are capturing a ghost.
A ghost. I like that.
Yeah, because a multinational enterprise is, it's a living, breathing, constantly shifting organism. The most significant compliance traps, the specific moments where the absolute highest penalties get assessed, they rarely happen when the company's just sitting there doing business as usual.
Right. The day-to-day operations are usually fine.
Exactly. The real danger zones occur when the company is in motion, like when it liquidates a subsidiary or when it swallows a competitor, or honestly, when it simply checks a box on a form to completely alter how the U.S. government perceives its existence.
And that motion is exactly what we are tracking today. Welcome to the deep dive. If you're listening to this, you likely already know the foundational rules of filing these complex international tax forms. You know who the filers are.
We assume you know the basics.
Right. But our mission today is to untangle one of the most intimidating webs in the entire Internal Revenue Code. We're looking at what happens to Form 5471 and its sprawling universe of associated schedules during those major corporate lifecycle transitions.
Which is a lot to cover.
It is. We want to ensure you don't trigger a massive audit just because an entity shed its old identity and took on a new one.
And to map this out, we are relying on a very specific and, frankly, an incredibly dense stack of source materials today.
Dense is an understatement.
Oh, absolutely. We are analyzing the Internal Revenue Manual penalty guidelines, specific entity classification treasury regulations, and the incredibly detailed, newly revised December 2025 instructions for Form 5471.
And we really need to emphasize those December 2025 revisions.
We do, because they fundamentally rewrite how certain transition years are handled.
So let's just jump right into it. Let's start with what is probably the most deceptive transition of all, a change that happens entirely on paper. The entity classification election.
Ah, yes.
Like a company operating in Germany or Japan wakes up one morning and decides it just doesn't want to be treated as a corporation anymore for U.S. tax purposes.
Right. Under Treasury Regulation 301.7701-3, they can file Form 8832, and they just change their nature.
The famous check-the-box regulations.
Exactly. Which were introduced originally back in the late 90s. And honestly, this was supposed to simplify things.
Was it really?
Yeah. Because instead of the IRS having to analyze a foreign entity's local corporate charter to see if it had centralized management or limited liability to decide if it was a corporation or a partnership.
Which sounds like a nightmare.
It was a nightmare. So the Treasury just said, hey, we will give you a list of eligible entities. You just check a box and tell us what you want to be.
Which sounds incredibly freeing for the taxpayer. Like, yesterday I was a corporation, and today, hey, I am a disregarded entity.
Right. But the downstream impact on Form 5471 is violent.
Violent. That's a strong word for accounting.
But it's true.
Yeah.
Because for U.S. tax purposes, that corporation didn't just, change its name badge. It died.
Oh, wow.
Yeah. It is a deemed liquidation.
And that is the crucial mental leap you really have to make here, right?
Exactly. The foreign entity physically still exists. It still has the same employees, the same factory, the same bank accounts in its home country. The local foreign government still taxes it as a corporation.
But the U.S. tax code looks at that check-the-box election and says something entirely different.
Right. The U.S. says the corporation we were tracking has been completely liquidated and its assets distributed. And because of that deemed death, the filer is forced to check Item D on page 1 of Form 5471.
Okay, Item D, the final year box.
Yes. Item D is not for when you just sell the company. You check this box only if this is the final year of the foreign corporation's existence as a corporation for federal tax purposes.
So checking the box literally kills the corporation on paper.
Right. The revised instructions explicitly single out an election to treat the foreign corporation as a disregarded entity as a mandatory trigger for Item D. You are officially closing the book on this corporate iteration.
So you check Item D, you tell the IRS this entity is done, but you and I both know the IRS doesn't just let an income-producing asset vanish into the ether.
No, they absolutely do not.
It's almost like, and tell me if this analogy works, it's like a corporate witness protection program.
Okay, I like where this is going.
The entity gets a totally new identity and new life, but the handler at the agency still needs to know it's the exact same guy so they can track his income.
That is a perfect analogy. And the handler, in this case, is the automated penalty systems of the IRS.
Which are notoriously unforgiving.
Highly unforgiving.
Yep.
So to keep tabs on this entity entering witness protection, the IRS uses a highly specific tracking mechanism. We can call it the Employer Identification Number Shuffle, or the EIN Shuffle.
The EIN Shuffle, okay, how does that work?
Well, under Treasury Regulation 301.6109-1, subsection B, paragraph 2, subparagraph V.
That's a mouthful.
It is, but it's important. Under that regulation, a foreign entity is strictly required to have an EIN to even file the Form 8832 classification election.
But wait, hold on. A lot of these foreign subsidiaries never even had a U.S. EIN, right?
Very true.
Like, if I'm a French subsidiary of a U.S. parent and I don't have U.S. effectively connected income and I don't have U.S. employees, I never needed to register for a U.S. employer number.
You wouldn't have one, no.
I was probably just filing my Form 5471 using, like, a reference ID number.
Yes, and that is incredibly common. The IRS allows filers to generate their own unique alphanumeric reference ID number, which can be up to 50 characters long, specifically because not every foreign corporation has or even needs an EIN.
Right.
So on page 1 of Form 5471, you have Item 1B1 dedicated to the actual EIN and Item 1B2 dedicated to the reference ID number.
But the moment that French subsidiary wants to check the box to become a disregarded entity, that Treasury regulation kicks in.
Exactly. The IRS says, oh, you want to change your status? You must go get an official EIN first.
Okay, so they get the EIN. What's the problem?
It creates a massive reconciliation problem for the IRS's computers.
Yeah.
Historically, the computer has been tracking this French subsidiary for maybe 10 years under its custom reference ID number.
Right.
Suddenly, the entity files a check-the-box election using a brand new, never-before-seen EIN. Then, at the end of the year, the U.S. parent files a Form 5471. If they just slap the new EIN on the form and drop the old reference ID, what does the IRS computer see?
I'm guessing the computer sees that the old entity simply stopped filing. It looks like a completely missing return.
Yes.
And it sees this brand new EIN popping into existence out of nowhere.
Which is the fastest way to trigger an automated penalty notice under Section 6038.
Oh, no.
Yeah. So to prevent this, the December 2025 instructions outline a really unforgiving correlation requirement. For the very first year that Form 5471 is filed after an entity classification election is made, the preparer must hard-code the link between the old identity and the new identity.
Okay, so walk me through the actual mechanics of that. If I'm sitting there staring at page 1 of the form, what am I literally typing into those boxes?
You must enter the newly minted EIN into Item 1B1. That is the new primary identity.
Okay, got it.
Then you are explicitly required to enter the old reference ID number into Item 1B2. You are visually linking them for the processing center.
So they see both.
Right. The instructions state this correlation is required to prove to the IRS that this new EIN belongs to the exact same tax history associated with the old reference ID.
What if I had multiple old reference ID numbers? Like maybe different U.S. shareholders were tracking the same foreign company using their own internal codes before they finally consolidated.
The instructions anticipate that exact nightmare. If there were multiple old reference ID numbers, you enter the new primary one in 1B2, and then you must list every single previous reference ID in Item 1B3.
Wow, okay.
And you have to format it perfectly. Separated only by a space. No special characters, no commas.
Wait, no commas, just spaces.
Just spaces. If you break this chain of custody, the IRS Internal Revenue Manual penalty guidelines state that these Section 6038 penalties are systemically assessed.
Systemically, so a machine just flags it.
Yes. The computer just mails you a bill for $10,000 per form because it assumes you failed to file for the legacy entity.
$10,000 just because you used a comma instead of a space. That is brutal.
It is.
But let's follow the data here. The entity successfully navigates the Witness Protection Program. It checks Item D for its final year as a corporation. It correlates its new EIN perfectly with spaces.
Right.
So the entity legally vanishes from the Form 5471, but the assets are still there. The factory is still churning out product. If the financial data isn't on the Form 5471 anymore, whose desk does it land on next?
Well, it migrates to Form 8858.
Okay, Form 8858.
Which is the information return of U.S. persons with respect to foreign disregarded entities and foreign branches. Because the entity is now disregarded, its assets, liabilities, and income are treated as being directly owned by its tax owner.
The tax owner being the entity directly above it in the organizational chart, right?
Exactly.
So if a controlled foreign corporation, a CFC, owns this newly disregarded entity, the CFC is the tax owner.
Correct. The CFC is still filing a Form 5471, but now it has this disregarded entity sitting inside of it for U.S. tax purposes.
Like a Russian nesting doll.
Yes. So the preparer must answer yes to question 3A on page 2 of Form 5471, which asks if the foreign corporation is the tax owner of a foreign disregarded entity.
Okay.
And depending on your filer category, specifically Category 4, 5A, or 5C, you must attach the entire Form 8858 to the Form 5471.
And this is where the compliance burden actually doubles, doesn't it?
Right.
Because the source materials provide an explicit mandatory mapping table. You don't just attach the new form and walk away.
No, you absolutely do not.
You have to weave the data from Form 8858 directly into the schedules of Form 5471.
The IRS demands a perfectly consistent story across all international forms. The instructions dictate that if amounts are reported on certain schedules of the Form 8858, they must be taken into account when determining the amounts reported on the equivalent schedules of the parent's Form 5471.
Okay, the mapping looks straightforward on the surface at least. Form 8858, Schedule C, which is the income statement, flows into Form 5471, Schedule C.
Right.
Form 8858, Schedule F, the balance sheet, flows to Form 5471, Schedule F. Schedule H maps to Schedule H, Schedule M maps to Schedule M.
But you have to look at the cross-schedule nuances. For example, Form 8858, Schedule J, which tracks accumulated earnings and taxes, actually splits. It flows into Schedules E and E1 of Form 5471, which deal with income and war profits taxes.
Okay, I have to stop you there and just push back on this entire concept.
Okay, go ahead.
I am attaching the Form 8858 to the return. The IRS literally has the document in their hands. Why are they forcing accountants to do this massive consolidation exercise to roll the data up into the Form 5471 schedules?
That seems redundant, I know.
Is this just administrative bloat? Just making accountants do the same math twice to justify higher compliance fees? Does this mapping actually serve a structural purpose?
It is the furthest thing from administrative bloat, I promise you.
Yeah.
The mapping is required because of the intense friction between local foreign accounting and U.S. tax principles.
What kind of friction?
Well, Form 8858 represents the raw, on-the-ground operations of that disregarded entity. It is usually recorded in the local functional currency using local accounting standards. But you cannot simply add a French branch's local net income to a U.S. parent's tax return.
Right, because the rules are totally different.
Exactly. It has to survive the JAP to tax hurdle.
The gauntlet of converting generally accepted accounting principles, or whatever the local foreign equivalent is, into U.S. earnings and profits, or E&P.
Exactly. E&P is the lifeblood here. When you take the raw data from Form 8858 and map it to Schedule H of Form 5471, you aren't just copying numbers. You start with the net income per the foreign books. Then, you are legally required to make adjustments under Regulations Section 1.964-1, subsections B and C.
And what kind of adjustments are we actually talking about here? Give me an example.
Massive ones. You have to reverse out local foreign depreciation and completely recalculate it using U.S. methods.
Just throw out their math entirely.
Yep. If 20% or more of the gross income is derived from U.S. sources, you are forced to use U.S. straight-line depreciation under Regulations Section 1.312-15. You have to completely recalculate inventory accounting under Section 471 and apply the uniform capitalization rules of Section 263, Cap A. You have to strip out uncertain tax positions and deferred taxes that local rules might allow, but U.S. rules completely ignore.
So the Form 8858 is basically just the unrefined ore pulled out of the ground.
Yes.
And the Form 5471 is the refinery. The IRS forces you to map it so they can audit the exact mathematical steps you took to turn local foreign income into U.S. taxable E&P.
That is the perfect way to look at it, the refinery. And the mapping doesn't stop with just those two forms either.
Of course not.
To maintain that airtight narrative, the Form 5471 also has to intersect seamlessly with other massive compliance documents. For example, consider the interest expense limitation under Section 163, subsection J.
Form 8990. That's the form where you calculate how much of your interest expense is actually deductible versus how much is disallowed because you have too much debt relative to your earnings.
Right. Question 15 on Form 5471 explicitly asks if the foreign corporation has any interest expense disallowed under Section 163, subsection J.
And I'm guessing you can't just throw a ballpark number in there.
No, if the answer is yes, you cannot just estimate it. You must enter the exact dollar amount derived directly from Form 8990. The forms are functionally tethered together.
And we see that same exact tethering with asset reporting, too.
We do.
Like item E on page 1 of Form 5471 is a checkbox for, quote, accepted specified foreign financial assets. If you check that box, you are basically signaling to the IRS, hey, I am reporting these assets deeply within this Form 5471, so I am not going to double report them on my Form 8938.
Which is a huge relief for the taxpayer, honestly. But it also means if the IRS audits your Form 8938 and sees missing assets, they're going to immediately pull your Form 5471 to verify you actually checked item E and properly disclose the assets there.
The web of cross-verification is just absolute.
It's inescapable.
Speaking of webs, the source materials include a really fascinating historical artifact regarding how the IRS handles overlapping jurisdictions. I'm talking about Treasury Decision 8850.
Oh, yes. TD 8850. This Treasury decision tackles the direct collision between two different reporting statutes, Section 6031 and Section 6038.
Right, because Section 6031 requires a standard partnership return, Form 1065, if a foreign partnership has U.S. source income.
Yes.
But then Section 6038 requires Form 8865 if a U.S. person controls a foreign partnership. So if I am a U.S. parent and I control a partnership in London, and that London partnership happens to sell products into the U.S., generating effectively connected income, I am caught in both statutes.
You are. You're doing double duty. And for years, practitioners argued this was just an absurd duplication of effort. Why file a Form 1065 and a Form 8865 for the exact same entity?
It seems crazy. So what did TD 8850 do?
Well, Treasury Decision 8850 addressed this overlap, but they refused to eliminate the dual filing requirement entirely.
Why? If it's the exact same entity, isn't it the exact same income?
Because the forms tell completely different stories to different IRS departments. The Form 1065 is hyper-focused on the income effectively connected to the United States. It is designed to capture the tax liability generated strictly within U.S. borders.
Okay, what about the other one?
The Form 8865, much like the Form 5471, is designed to capture the global worldwide income of that partnership as it relates to the U.S. controlling partner for anti-deferral purposes.
Oh, I see.
Furthermore, the Treasury explicitly noted that the reporting might differ wildly because the two forms might be operating on completely different tax years or different accounting methods.
So even when the IRS admits you are reporting the same entity twice, they justify it by pointing out that the angle of the snapshot is completely different.
Exactly. The angle is different, the timing is different, and the ultimate tax computation is different.
Okay, so we have thoroughly mapped what happens when an entity changes its classification on paper. And we have tracked the flow of data across the forms.
Right.
But all of that is relatively peaceful compared to what happens when companies physically collide. When an entity actually acquires another company or merges or is just torn apart.
Now we enter the domain of Schedule O organization or reorganization of foreign corporation and acquisitions and dispositions of its stock.
Let's talk about the trigger. When does a taxpayer even have to look at Schedule O?
The liability to file Schedule O arises primarily under Section 6046. It kicks in when a U.S. person acquires, whether in one single transaction or a series of creeping transactions, outstanding stock of a foreign corporation that equals 10% or more of the total combined voting power or value.
So the magic number is 10%. You hit that threshold, you're filing Schedule O.
Exactly.
But the schedule isn't just for straightforward stock purchases, it's for reorganizations. And in the tax world, that word has a notoriously specific, heavily litigated definition.
It does.
Usually, if an accountant says reorganization, they are referring to the highly structured, tax-free transactions described in Section 368, subsection A, paragraph 1, statutory mergers, stock-for-stock swaps, asset-for-stock swaps.
That is the standard definition, yes. But here is where the trap is set.
Uh-oh.
For the specific purposes of reporting under Section 6046, the definition of reorganization is massively expanded.
How so?
The regulations state that for Schedule O, the term reorganization means not only those traditional transactions described in Section 368, subsection A, paragraph 1, but also any other transaction or series of transactions which has the, quote, same effect.
Same effect. That is terrifyingly broad.
Extremely broad.
That means the IRS isn't just looking for the formal legal labels of a merger, they are looking at the underlying economic reality. If you shuffle assets around through a series of messy, non-standard liquidations and drops, but the end result is that a U.S. person consolidated ownership of foreign assets.
The IRS says it walks like a reorganization, it quacks like a reorganization, you owe us a Schedule O.
And Schedule O is not a light lift, I've seen it.
Not at all. Part I requires a complete listing of officers and directors. Part 2 requires a detailed registry of shareholders. But the real burden is the transactional disclosure.
What do you have to disclose?
You must detail every single asset transferred, every note or security issued, the identifying numbers of every single person involved, and this is the part that usually shocks people, an exhaustive analysis of the changes in the corporation's surplus accounts occurring on or after January 1st, 1963.
1963, the Kennedy administration.
Yes.
The IRS expects you to track surplus account changes back over 60 years.
They absolutely do, because earnings and profits from decades ago can still dictate the taxability of a distribution today.
That is wild.
Now, there is a tiny measure of relief regarding duplicative reporting when these massive reorganizations happen. The amendments to the regulations under Section 6038, Cap B, provide a specific carve-out.
Okay, Section 6038, Cap B. That usually requires reporting when a U.S. person transfers property to a foreign corporation, right?
Correct. The exception states that if a U.S. person exchanges stock of a domestic or foreign corporation for stock of a foreign corporation, and it is done pursuant to an asset reorganization described in Section 368, subsection A, paragraph 1, subparagraph Cap C, subparagraph Cap D, or subparagraph Cap F.
The classic C, D, or F reorgs.
Yes. If it falls under those specific subparagraphs, and it is not treated as an indirect stock transfer under other rules, then the taxpayer is exempted from reporting the transfer under Section 6038, Cap B.
Okay, so the logic being that the IRS is already capturing the intricate mechanics of those specific reorganizations on Schedule O and the underlying Form 5471 anyway.
Exactly. They don't need a third form telling them the exact same story.
Okay, so the law demands comprehensive mapping of these transactions. But I always struggle to visualize how the IRS could possibly track a global web of share-for-share drops and indirect acquisitions. If I buy 10% of a holding company, how deep into the rabbit hole am I really expected to go?
Let's ground this with the explicit hypothetical provided in the source text, the Mr. Lyons example.
Yes, Mr. Lyons.
This scenario perfectly illustrates the cascading nightmare of constructive ownership.
So imagine Mr. Lyons, just a U.S. person making an investment.
Mr. Lyons acquires a 10% ownership stake in a foreign entity called Corporation F. 10% seems simple enough.
Right.
But Corporation F is a holding company. It is the 100% owner of two other operating foreign corporations, Corporation FI and Corporation FJ.
Okay, keeping track.
Furthermore, Corporation F owns 50% of another entity, Corporation FK. And just to complicate the ownership chain from above, Corporation F itself is 90% owned by a massive foreign conglomerate, Corporation W.
So Mr. Lyons just bought 10% of F. He has absolutely no direct connection to WFI, FJ, or FK. He is just a minority shareholder in one specific tier of this structure.
But under the constructive ownership rules of the U.S. tax code, Mr. Lyons' 10% stake in F cascades down the chain. The instructions dictate that Mr. Lyons must complete and file Form 5471 and Schedule O not just for Corporation F, but for every corporation in which he is deemed a 10% or more shareholder.
Wait, really? Because F owns 100% of FI and FJ, Mr. Lyons indirectly owns 10% of them.
Yes.
So he is suddenly on the hook for filing full Schedule O's for FI and FJ, mapping out their officers, directors, and reorganizations, even though he might not even have management access to their internal accounting.
Oh, it's worse. The instructions also mandate that Mr. Lyons is required to submit a visual organizational chart.
A visual chart.
Yes, if the foreign corporation is a member of a chain of corporations, he must physically map out the entire corporate family tree for the IRS, detailing the percentages of ownership at every single level.
And what happens if Mr. Lyons, sitting in his office in Chicago, simply can't get the certified 1963 surplus account history for Corporation FJ down in Brazil? Can he just file what he has for the parent company, attach a note explaining he is a minority shareholder, and claim he substantially complied with the law?
He cannot rely on a defense of general substantial compliance. The sources specifically highlight a 1997 Field Service Advice, an FSA, that addressed exactly how the IRS interprets substantial compliance under Section 6038.
What happened in the FSA?
Well, the taxpayer in that case had filed the forms but had significant understatements of related party transactions, and they had inconsistencies in their earnings and profits reporting. They argued that because they filed the bulk of the required information, they had substantially complied.
Like, I got a B- on the test, so I passed.
Right. But the IRS vehemently disagreed. The FSA concluded that Congress did not intend for substantial compliance to be evaluated on a generalized, aggregate approach. You do not get a passing grade just because 70% of the form is filled out.
So how do they grade it?
The IRS evaluates substantial compliance on a significant item by significant item basis. Every line matters. If you omit the voting stock percentage in item C, if you fail to attach a required Schedule M for related party transactions, if you leave out the reorganization data on Schedule O,
It's an automatic fail.
a schedule required but not prepared means an automatic absolute failure.
And the penalty for that failure is ruthless, isn't it?
Unbelievably ruthless. The Internal Revenue Manual empowers agents to look at your tax returns for the preceding 2 years, pull your forms 8832, demand certified English translations of foreign dissolution certificates officially stamped by foreign governments.
Wow.
If you miss a significant item, you're exposed to the $10,000 initial penalty per form per year. And if you don't fix it when notified, it scales up with continuation penalties reaching an additional $50,000 per form.
Okay, so filing Schedule O in those visual organizational charts serves as the flare gun. It notifies the IRS that the structure of the multinational has changed. You've drawn the map. But a map just shows you where the borders moved. It doesn't tell you the financial toll of the war.
Right.
How do you calculate the actual dollars and cents of a merger? When Company A absorbs Company B, how do their historical earnings combine?
That brings us to the deepest, most complex math on the return. Schedule J, the accumulated earnings and profits of controlled foreign corporations.
Schedule J is where the theoretical reorganization on Schedule O physically hits the balance sheet.
Exactly. Schedule J is where recognition events and non-recognition events physically manifest on the tax return. Let's focus on non-recognition transactions under Section 381.
Okay, Section 381.
This occurs when one foreign corporation acquires the assets of another foreign corporation in a tax-free reorganization or liquidation.
Let's set up a scenario so we can visualize this. We have Company A, a highly profitable foreign subsidiary with millions in accumulated earnings. And we have Company B, a foreign subsidiary that has been bleeding cash for a decade. It has a massive deficit in its earnings and profits. The U.S. parent decides to merge them. Company A absorbs Company B in a non-recognition transaction under Section 381. What happens to Company B's massive deficit?
Normally, according to the Schedule J instructions, the earnings or deficits of the target carry over to the surviving foreign corporation. You report this migration on line 5A of Schedule J, labeled E&P, carried over in non-recognition transaction. You determine the exact amount based on the rules and regulations, Section 1.367, subparagraph B7.
But wait, if I am an aggressive tax planner, I am looking at this merger and thinking, jackpot!
Oh, definitely.
Because I can take Company B's massive historical deficit, carry it over to Company A, and immediately use it to wipe out Company A's positive earnings. Suddenly, Company A has zero positive E&P, which means when it distributes cash to the U.S. parent, it's treated as a tax-free return of capital instead of a taxable dividend.
And the IRS is acutely aware of that exact strategy. It is one of the oldest tax planning maneuvers in the book, which is exactly why Congress and the Treasury created the concept of the hovering deficit under Section 381, subsection C, paragraph 2, subparagraph cap B.
The hovering deficit, it sounds like a sci-fi villain.
It does. But the rule completely neutralizes the strategy you just described. If the surviving foreign corporation, or the target, had a deficit in E&P prior to the transaction, that deficit is fundamentally recharacterized. It becomes a hovering deficit.
So it doesn't just wipe out the good E&P.
No. On Schedule J, if the amount entered on line 5A that carried over E&P is a negative number, the instructions force you to quarantine it.
How does the quarantine work mathematically on the schedule?
You must include an amount equal to the deficit as a positive number on line 5B in the standard E&P columns. This essentially zeroes out the deficit, so it cannot reduce the profitable company's existing earnings.
Oh, clever.
Then, you take that same total amount and enter it as a negative number over in column D of line 5B. Column D on Schedule J is a specialized quarantine zone specifically designated for hovering deficits and suspended taxes.
You know what this reminds me of? It reminds me of moving in with a new roommate.
Roommate.
Yeah, imagine you are Company A. You've been responsible, you have a solid savings account. Your new roommate, Company B, moves in, and they bring a mountain of terrible credit card debt from their past. The IRS rule essentially says you cannot use your responsible past savings to pay off your new roommate's old credit card debt. That debt hovers over the apartment. It is quarantined.
That is an exceptionally accurate analogy. The hovering deficit locked in column D can only be used to offset undistributed post-transaction E&P. It can only be paid off by the new combined income that the roommates generate together in the future. It absolutely cannot touch the pre-transaction accumulated E&P of the profitable company. When the combined entity finally does generate enough future earnings to offset the deficit, you report that release on line 13, hovering deficit offset of undistributed post-transaction E&P.
And just to add another layer of complexity, this entire calculation, the deficits, the future earnings, it all has to be tracked in the foreign corporation's local functional currency, right?
Under Section 986, subsection B, yes. Everything on Schedule J is maintained in functional currency. But tracking regular E&P is just the baseline. The true nightmare of the modern Form 5471 is tracking previously taxed earnings and profits. PTEP.
Oh, PTEP, which happens on Schedule P.
Yes, and Schedule P is where the sheer volume of U.S. tax legislation over the last decade really shows its teeth. Because you don't just have one bucket of previously taxed income.
Not even close, right?
Not even close. If you look at the December 2025 instructions, column E of Schedule J, which flows from Schedule P, tracks PTEP across 10 different subgroups.
10 subgroups. How is a mid-sized accounting department even supposed to track that without bespoke enterprise-level software? Why are there 10 buckets for money that has already been taxed?
Because the U.S. Congress keeps passing new tax regimes, and every regime has its own rules for how that specific flavor of income is treated when it is eventually distributed. You have different rules under Sections 960, 965, subsection G, 245, cap A, subsection E, paragraph 3, and 986, subsection C.
Okay, give me some examples of these flavors. What are we looking at?
You have reclassified Section 965, subsection A, PTEP, which is the transition tax from the 2017 tax reform. You have General Section 959, subsection C, paragraph 1, PTEP. You have Section 951, cap A, PTEP, which is the guilty inclusion global intangible low-taxed income.
It's an alphabet soup.
It is. And each bucket has to be ring-fenced because it might carry different foreign tax credits or currency gain implications.
Okay, so you have this incredibly fractured landscape of E&P and PTEP across Schedules J and P. What happens when the company finally just cuts a check? Like when it makes an actual cash distribution to the U.S. parent?
The distribution flows through Schedule R, which acts as the ultimate verification engine. Schedule R must map perfectly back to the historical E&P on Schedule J and the previously taxed income on Schedule P. If the math doesn't tie out exactly, the return is wrong.
Let's run a hypothetical to prove the math. A simple scenario based strictly on the text instructions for Schedule R. The foreign subsidiary makes a cash distribution of $100 to the U.S. parent.
I just write $100 dividend on the form, right?
In this universe, nothing is just a dividend. On Schedule R, column A, you must describe the distribution and use specific code sections to identify the exact tax consequences of every single dollar. You cannot combine them. Our single $100 cash transfer might actually be comprised of 4 distinct tranches. 4 tranches for a single $100 check. Okay, walk me through the waterfall.
First, under the ordering rules of Section 959, subsection C, distributions are always considered to come out of previously taxed earnings first. So let's say the first $30 is a non-taxable distribution of PTEP under Section 959, subsection A. You list that on its own row.
Non-taxable because we already paid tax on it under GILTI or Subpart F in a prior year. Makes perfect sense. We have $70 left.
Second, let's say $15 comes out of standard earnings, but it qualifies for the participation exemption. So you list $15 as a taxable cash dividend, eligible for the dividends received deduction under Section 245 Cap A.
Okay, so that 15 is technically a dividend, but we get a deduction to offset it. We still have $55 unaccounted for.
Third, let's say $25 is just a standard old-school taxable dividend out of remaining E&P under Section 301, subsection C, paragraph 1.
Standard dividend, fully taxable, that leaves $30.
Well, what if the foreign corporation has now completely run out of earnings and profits? It has zero E&P left. Any further distribution is a return of capital. So $10 might be a non-taxable distribution applied directly against your stock basis under Section 301, subsection C, paragraph 2.
Okay, let me do the math. 30 plus 15 plus 25 plus 10, that is $80. The E&P is gone, the stock basis is reduced. So if I've only accounted for $80, the remaining 20 has to be capital gains, right? Because the distribution exceeds my basis in the stock.
You are spot on. The remaining $20 falls under Section 301, subsection C, paragraph 3, treated as a taxable distribution resulting in capital gain. You are required to report all of these parts on separate rows on Schedule R because they are taxable or non-taxable by reason of different code sections.
The granularity is mind-numbing.
And here is the critical verification check that catches so many preparers. The total of all amounts entered in column D of Schedule R, which tracks the E&P reduction, must exactly equal the amount reported on line 9, column F, of Schedule J.
They have to match perfectly.
Perfectly. And the PTEP portion must tie flawlessly to Part 1, line 8 of Schedule P. The interconnectedness is absolute. And because PTEP was distributed, you also have to calculate the foreign currency exchange gain or loss between the time the income was originally earned and the time it was distributed under Section 986, subsection C. You report that on Schedule 1, line 6.
So we have mastered the math of mergers. We understand the hovering deficits protecting historical E&P, and we've mapped the granular multi-tranche distributions across Schedules R, J, and P.
We have.
But merging two companies often means merging two completely different fiscal calendars. What happens when the actual timeline of the company shifts?
This brings us to the most disruptive year of change complication and a massive legislative update highlighted in the December 2025 Form 5471 instructions, the One Big Beautiful Bill Act of 2025.
The OBBBA, Public Law 11921. This was the hook we started the show with. The 30-day calendar shift. Why does a company's fiscal year matter so much to the IRS?
To understand the stakes, we have to look at the baseline rule, Section 898. This section dictates the annual accounting period of a specified foreign corporation, or SFC. Generally, the rule states that an SFC is required to have the exact same tax year as its majority U.S. shareholder.
Which makes logical sense. If the U.S. parent is on a calendar year ending December 31st, the foreign subsidiary must also be on a calendar year ending December 31st. That ensures that when the foreign subsidiary generates Subpart F income or GILTI in December, it flows instantly onto the U.S. parent's tax return in the exact same taxable year.
Precisely. However, historically, there's a massive exception. Section 898, subsection C, paragraph 2, permitted what was known as a one-month deferral election. A foreign subsidiary could legally elect to have a tax year beginning 1 month earlier than its majority U.S. shareholder.
Okay, so if the U.S. parent ended its year on December 31st, the foreign sub could elect to end its year on November 30th. But why would Congress ever write that into law? And more importantly, why would they pass a massive new piece of legislation in 2025 just to close a 30-day gap? It seems so minor.
It seems minor until you realize the sheer scale of income deferral that multinational corporations could achieve with it. Imagine a massive foreign subsidiary generating $1 billion of income in December of year one.
$1 billion in 1 month. Okay.
Because the subsidiary's tax year closed on November 30th, that $1 billion earned in December doesn't get reported by the subsidiary until its next tax year closes on November 30th of year 2.
Wow. Wait, so that December income doesn't hit the U.S. parent's tax return until the end of year 2.
Exactly. They effectively achieved an 11-month deferral on a massive portion of global income. They could delay paying U.S. taxes on December earnings for nearly an entire year. That seemingly minor calendar tweak was bleeding billions of dollars in delayed tax revenue from the Treasury.
So closing that gap is a massive, immediate revenue generator for the government.
It is. Section 70352 of the OBBBA explicitly repeals the one-month deferral election. The law states that for a tax year of a specified foreign corporation beginning after November 30th, 2025, the SFC may no longer have a tax year beginning 1 month earlier than the majority U.S. shareholder year.
Okay, the loophole is slammed shut. But mechanically, how does a massive multinational corporation physically shift its calendar? They have been operating on a November 30th year-end for decades. Now the law says they have to be on a December 31st year-end. How do they actually transition?
The transition forces the creation of a first required year and results in a compliance nightmare. The short year Form 5471. The CFT's previous legacy year ended November 30th, 2025. Its new first required year must end on December 31st, 2025.
Which means the filer must submit an entire standalone Form 5471 covering a tax year that is exactly 1 month long. Just December 2025.
Yes.
Yeah.
A 1-month tax return. You have to run the entire JAP tax gauntlet, isolate the exact E&P generated in those 30 days, and map it across all the schedules. The risk of double counting earnings or missing transition events is incredibly high.
I can imagine.
To manage the chaos, the IRS issued specific guidance. Notice 2025-72 dictates how foreign income taxes must be handled during this bizarre short period.
Because the foreign jurisdiction, say the German tax authority, doesn't care about the U.S. OBBA legislation, they're still taxing the entity on a normal 12-month calendar. So the U.S. parent gets a single tax bill from Germany for the whole year, but they have to somehow chop it up to fit this 1-month U.S. short return.
Exactly. The U.S. shareholder has to mathematically allocate the foreign taxes paid across the specific periods. On Schedule E of Form 5471, Part 1, Section 1, Column J, is where you report the foreign taxes properly allocated to the income of the CFC.
What did the new instructions say about that?
The new December 2025 instructions explicitly mandate that for the first required year, the CFC must have the amount of each foreign income tax allocated to that short year listed in Column J. Furthermore, a detailed statement reflecting the mathematical methodology for each foreign income tax subject to allocation must be attached to the return.
And what if the foreign subsidiary made a massive dividend distribution during that weird 1-month transition period? How is that treated?
That is addressed by the pro rata share transition rule, authorized under Section 70354, subsection C, paragraph 2 of the OBBBA, and detailed heavily in Notice 2025-75.
The pro rata share transition rule.
Under this transition rule, certain dividends paid or deemed paid by a CFC during this shift are not treated as dividends for the purposes of applying Section 951, subsection A, paragraph 2, subparagraph cap B. The IRS wants to ensure that these transitional distributions don't inappropriately reduce the U.S. shareholders' subpart F inclusion.
They're watching everything.
They are. To enforce this, on page 6 of Form 5471, Schedule G, they added a brand new, highly specific question. Question 22B.
What does 22B ask?
It asks if any amount of the dividends paid during the tax year were described in the OBBBA transition rule, but were nonetheless treated as a dividend by the U.S. person filing the return. They're looking for taxpayers who are trying to claim the dividend benefit despite the transition rule.
And if a preparer checks yes, if they say yes, we treat it as a dividend anyway.
If you check yes, you are inviting immediate scrutiny. You must include a robust statement describing exactly why the U.S. person is entitled to treat this amount as a dividend after the application of the pro rata share transition rule.
You have to prove it.
And crucially, this statement must describe exactly how the U.S. person determined that the dividend increased the taxable income of a U.S. person subject to federal income tax. You have to prove the underlying map to the IRS, demonstrating that the income didn't just escape taxation during the chaotic shuffle from the old calendar to the new calendar.
Because that is the ultimate goal. Whether it's a paper-only entity classification change, a massive statutory reorganization, or a calendar shift. The overarching theme of Form 5471 is closing the gaps. The IRS is demanding a seamless, airtight mathematical narrative of every single dollar of global earnings.
That is the core takeaway. The IRS views these corporate transitions not as simple administrative updates, but as high-risk events where taxable income is most likely to slip through the cracks.
Let's quickly recap the terrain we've covered today. We started with the deceptive simplicity of checking a single box on Form 8832, and how that legal fiction of a deemed liquidation triggers a final year Form 5471, demanding an intricate EIN correlation to maintain the chain of custody.
Right. And then we followed the financial data as it migrated to Form 8858, mapping the schedules and running the grueling gauntlet of GAAP-to-tax conversions, while ensuring our story matched our interest limitations on Form 8990.
We charted the treacherous waters of corporate reorganizations on Schedule O, learning that the IRS defines reorganization incredibly broadly as any transaction with the same effect. And we saw how Mr. Lyons got trapped by constructive ownership, facing draconian penalties evaluated strictly on a significant item by significant item basis.
We dove deep into the math of mergers on Schedule J, isolating the hovering deficit to ensure past corporate failures couldn't be used to shield future combined gains. We explored the 10 granular subgroups of previously taxed income on Schedule P and perfectly mapped a multi-tranche distribution across Schedule R.
And finally, we unpacked the One Big Beautiful Bill Act of 2025, watching the government reclaim billions in deferred revenue by repealing the one-month deferral election, forcing an administrative nightmare of short-year tax returns and meticulous foreign tax allocations.
If we connect all of this to the bigger picture of where tax compliance is heading, it raises a profoundly provocative question.
Let's hear it.
When you consider the sheer volume of GAAP-to-tax conversions, the subschedule cross-referencing, the tracking of 10 different PTEP subgroups across decades, and the multi-form mapping required just to file a single Form 5471, we are arguably reaching the absolute physical limits of human accounting.
It certainly feels that way. The code has outgrown the medium of a static PDF form.
Precisely. How long will it be until global tax authorities finally recognize that manual data entry and layered PDF schedules are entirely obsolete for this level of economic complexity?
What's the alternative, though?
We may be rapidly approaching a future where the IRS bypasses Form 5471 entirely. A future where they mandate direct, real-time API integrations into a multinational enterprise's raw resource planning ledgers.
Direct access to the books.
Exactly. A world where the IRS's algorithms perform the functional currency translations, the GAAP-to-tax conversions, and the E&P tracking instantaneously, pulling the data before the accountants even have a chance to summarize it.
A real-time, automated audit of global ledgers. That is a staggering thought to end on. If the camera capturing the moving picture of tax reporting is currently broken, maybe the IRS just decides to tap directly into the company's security feed. Thank you for joining us on this deep dive. Keep questioning the structures, keep tracking those hovering deficits, and we will see you next time.